I'm good.
Unfortunately, the pay is the same.
Sorry, everyone, we had a little bit of technical difficulty.
Thank you. Sorry, I'm a few minutes late.
Not at all.
Thank you. But I actually have not.
All righty, Anthony has joined and the minutes were approved and now we're into the request for civilian retirement benefits. All right, again, are there any comments on the civilian request? Otherwise, motion to approve is in order. Motion,
I'm a.
Jody moves, anyone second? Tony, would you like to second?
I'll second.
Very good. Now you got
It's good to be here,
You
Bill.
got your name in print, memorialized forever. All those in favor signify by saying, raising your hand, signify by saying aye, whichever you'd like to do.
Aye.
Okay, there are no nays. There is one police request. Anything we need to know? I have a motion to approve.
I move.
Jody,
I'll second.
Paul second. All those in favor of the single police request? Aye. There are no nays. All right, there are 3 civilian requests for death benefit. Unfortunately. Anything extraordinary that of note? We have a motion to approve. So moved, Campbell. Second, Jerry Ward, second. Jenna Colonel, excuse me. All those in favor? There is equally unfortunately one police request for death benefits. I have a motion to approve. Motion. Second, Campbell. All those in favor?
Aye.
Very good. All right, the next item on the agenda is the ACG report. Phineas is, Jason's not joining us.
No, Jason is out of town, actually, it's conflict. So perfect, thank you all. So we've a couple pieces of information in front of you. I have 2 performance report. The first is the quarterly book performance as of September 30th that we always go through. We also have an update through October 31st. And, as happens quite, a bit as we meet monthly, the information much dated, right? Performance in November, a lot of it different, to much relief of many. So we'll talk a little bit about that, but still good to share this news. And then also do have really what I want to hit on today is a discussion around our international small cap portfolio. As you remember, we had Mondrian here last month presenting. We also have William Blair in the portfolio. At ACG, and we'll talk about this, very much like having small cap international within our portfolio, just like within the US. We want that small cap exposure, that ability to drive returns. Though I think our discussion is around the sizing of the 2 managers in the portfolio. Particularly, we've talked about this, the addition of Silchester recently in the last few months, their ability to move into kind of smaller cap names.
Could you not go into any further detail on that right now? Why don't we have
Perfect.
the performance report?
So we will talk about that. So first, I want to do the quarterly book. And again, we've seen these numbers. This is kind of more so this is our final performance for the end of the 3rd quarter of the calendar year, as well as we're able to compare ourselves versus peers, compare our managers versus some of their peers who do the same thing. And so maybe it's actually in the first tab, page 8. Just again, a quick reminder of, we've seen these numbers of what's going on in the market that's really driving this. And so what we're looking at page 8, again, this is all as of September 30th, but many of the major indices that we track, kind of how they've performed in the different periods. You can see year to date, 1 year, 3 year. And the things I want to point out first and foremost, so actually it doesn't really feel like it. Maybe it does some more now that we're in November. Really look at those first 2 columns, year to date, that's 23, and particularly the last 12 months. So that includes the 4th quarter last year, really kind of positive overall in terms of returns, really strong returns over that period. Again, it might not feel like it. Now, what's been kind of really doing well and driving these returns? Well, first and foremost, what we've talked a lot about this year is interest rates. And so these first 3 not green though, there's green, but these first three bars, I apologize, there's so many colors here, but in both the year to date and the 1 year, those are fixed income indices. The first one there, that middleish blue bar, that's the one we track the most, the Bloomberg aggregate. So you can see actually year to date, it's been negative. Over the past 12 months, it's slightly positive. And again, why is this? Rates have moved up quite a bit. Again, this year we talked a lot about expectations going into the year of recession. It hasn't happened yet. Hence, you can see these next few bars up quite a bit. Equity market's really strong. What you can see really, and this has especially happened over the last couple quarters, expectations that the Fed might need to raise rates even more. So this has pushed bond prices down. Well, you can see, like I said, overall, it's been a pretty strong year for equities. I'm going to highlight this gold bar year to date. That's the S&P 500. So we've talked quite a bit about this year, S&P 500, and really this has been driven by, for the most part, these 7 large cap growth technology names, the Amazon, the Netflix, the Googles, really, really strong this year as investors really want this technology, this kind of, everyone's talking about AI, that excitement. And just compare that gold bar, that S&P, to the one next to it, the purple bar. That's the Russell 2000. So that's U.S. small cap stocks. So again, overall equity is positive here in the U.S., but you can see quite a big dispersion there between the large cap and the small cap here in 23. And that's kind of a similar story you can see, over the trailing year, quite a bit of fall off. I will point out we've seen and started to see, this really started last year, a strong rebound and resurgence in international equities. You can actually look at that 1 year column, so that second one. The largest bar is the MSCI EAFE index. So again, for most of the last decade plus, we've talked about how it's really been U.S. outperforming international. Well, actually, over the last 12 months, we've seen that reverse a little bit. So actually, really kind of strong outperformance within international. Now, similar dynamic though, I'll point out, just like in the U.S., large cap significantly outperforms small. You can see international EAFE significantly outperforming that, I don't know, call it orange reddish bar. That's emerging markets. So again, quite a bit dispersion there, and really that emerging markets led by underperformance in China, the market continuing to struggle, and investors shrugging that off. So overall, this is again just kind of a reminder in graphic form. We've talked a lot about it, but overall, last 12 months it's been positive, but really kind of some key areas, particularly U.S. large cap, really driving that over the past year. What's not on this page is real estate. So our benchmark, which is everyone's benchmark, which is a combination of a bunch of managers, is the Odyssey. The Odyssey has struggled. So in 21 and 22, very, very strong returns. Over the past 12 months, real estate is down 12%. So again, if you were to kind of add that, think about that, it's not on here, but if you were to add how that would look on this graph, on that 1 year column, everything's up to the positive side. You can see commodities slightly down there on the right, but then we would add a -12 there for real estate. So again, now, if we were to add that the years before, 2022, that's flipped, right? That's the diversification we have in the portfolio, but that's certainly the impact. And then the only thing I want to add too, so really strong last 12 months overall, and broadly speaking, return-wise, but if you look to the columns further to the right, particularly the 3 year and really the 5 year, you can see those are going, basically down, right? As you look to the right, those return levels are going down. Overall, the last 5 years, particularly given what happened in 2022, and actually we're still including a decent amount of 2018, which was, a tough year in the marketplace. Actually, relatively muted returns. We've seen that across the board. That's both in our returns as well as the peers we compare ourselves to. Does that make questions? Again, I don't think anything here is necessarily news that we haven't talked about, but sometimes just kind of looking at a different form helps kind of put in perspective.
Why did the international markets outperform the U.S.?
So it's really kind of been a couple of things. So first and foremost, it has been a little bit just on a valuation standpoint. So if you think about, kind of what drives return, certainly it's earnings, from the underlying companies. It's, we can call it valuations. Sometimes we call it multiple expansions. Another way of saying is what are people willing to pay for it? And so what we saw, particularly at the end of last year, really in the fourth quarter, investors over the last several years have really discounted international markets. They haven't been as excited about it, particularly coming out of COVID. So particularly, U.S. was able to rebound better coming out of COVID. That really helped them, particularly in 21 and even in 20, as it flushed the market with all that capital the Fed did. And so we started to see, international was kind of, the economy was kind of late to that rally. So we saw a lot of investors kind of flood in from that standpoint. Questions? We can flip to page 20, which is on the second tab. So again, just how that's impacted us from a dollar perspective. So again, I'll start with the 1 year column. The last year overall been positive, really kind of led by, some of the equity markets. So at September 30th of 22, 12 months ago, we had $746 million in the portfolio. You can see over the last 12 months, we've taken out just under $30 million. Again, most of this to pay our benefit payments, our pension plan. And investments have added about $72 million to the portfolio the last 12 months. So as of September 30, we had $790 million in the portfolio. So overall, very strong last 12 months. Now, as we've talked about, we saw a pullback really in the last 3 months, so the third quarter of 2023. You can see we actually started the quarter, which would be July 1st of 23 at $826 million in the portfolio. You see we pulled back quite a bit. And why was this? Really, again, going back to these, we talked a lot about this, and I made these comments. It's this expectation of interest rates, right? So again, going into 23, everyone expected a recession coming. The economy very resilient, led by the consumer continuing to spend. So really strong economic gains. That was really, really great rally up until the summer, where again, it's one of those good news becomes bad news. All of a sudden, oh, we're not going into a recession. Well, that's great. Okay, maybe the Fed needs to raise interest rates even more. So again, that hurt bond prices, and then also that's negative for equities as it's harder to borrow and spend. So again, that's what's really led to that pullback in the quarter. I know we've talked quite about that, but overall, we ended the 9/30 at $790 million in the portfolio. And then if you look here at the bottom of this double page on page 21, just how that goes from an asset allocation standpoint. Again, our target asset allocation, very, very important, obviously. That fourth column, the over and underweights within our portfolio. And just point out these gray bars. You can see as we sit here November 30th, we're overweight by about 1%. So we're all in line with all of our policies here. We know we're going to fluctuate a little bit, and that's why we allow the plus or minus 5%. Overweight equities in the portfolio, which every year like this has been positive for us. Now, a lot of that's been driven by that run. Underweight fixed income, which fixed income has kind of been flat, so no real kind of major concern there. Overweight real assets in the portfolio by about 2%. And again, part of this being we've asked our managers for capital, and like most institutional investors, there is a queue. So that's what's led to some of this overweight. But also, again, our target's 15%. So we ended the quarter at 17% within real estate. Again, that's a little bit over our target. We will say, and this will kind of show, particularly over the last years, we can start to compare ourselves to peers. But relative to peers, that's on the higher side on the real asset. And so again, given kind of some of those dynamics last year, or excuse me, so far this year, that's been a detractor from our portfolio in this shorter period of time. But of course, longer terms continue to help out and provide that diversification. Page 22, just from a return standpoint at the overall portfolio level. There's over, you can kind of see on the right-hand side here, the kind of 3 months was the quarter, 1, 3, 5, and 10, just going down. And again, what we compare ourselves to is it's our portfolio. Our broad policy index is only a combination of stocks and bonds. So it's about 78% equity, 22% bonds. Our strategic portfolio incorporates that 15% to real estate. So just given that dynamic and how much real estate has moved the last couple of years, you can expect some big divergences between us and the broad policy index. That's the point. It's broad, much closer with our strategic policy. And then again, we compare ourselves to other public plans in the country who are between 100 and $1 billion within the portfolio. So looking over the trailing year, again, overall strong return over the last 12 months. We're up 9.5%. Not surprisingly, given, again, the dynamic of real estate and not being in the broad policy index, you can see, that big divergence between the broad policy index. We're much closer with our strategic policy index, about 1% off over the last 12 months. And again, really most of that just driven by our overweight that we've tried to and put in an exit from real estate, but haven't been able to pull out over the last 12 months. And then you can see the median public pension plan Up less than 1% over us, about 50, 60 basis points ahead of us. Again, we're a little bit tend to be overweight. Some of our peers also have a little bit more small cap than some of our peers. So giving us kind of some of that dynamic over the past 12 months. That's what's
Just for information's sake, the pure data, is that on a net basis or is that gross fees?
this is all gross.
Pure data is gross.
Yes.
And our data is net.
No, our data is gross as well.
Okay.
So we're comparing it gross. I'm sorry, our return is net, but we are using a net peer group. They're both net.
So they're both net.
They're both net.
That was my original.
Yes, yes. So, so that's kind of really kind of main differences over the past year. As you look down, you can see in the 3 and 5 year, again, given some of those dynamics, particularly 22, even in 18, as you can incorporate the 5 year, returns from an absolute perspective are lower, just given kind of the market dynamic. You can see from a rating standpoint, we're right there, really kind of in the middle of the pack versus other public pension plans over the last 5 years. We're ahead of our strategic policy index. And then over the 10 years, you see, a little bit higher returns continuing to kind of push up a little bit. We're at 6.5%, so in the top half of other public plans. And you can see actually over that time period, ahead of both of our broad and the strategic policy indices. So that's kind of, the high level of what's been driving kind of returns over the recent period.
And in fact, if you go back to calendar year of 2021, policy benefit, we are in the top quintile, as I recall, of our peer group for calendar year 2021. Certainly in the top quartile, but I think we're in the top quintile, within the top 20% of the peers. So our performance actually historically through calendar year 2021 was actually quite good, both in absolute terms and relative terms. 2022 unfortunately occurred. You can't prevent a year on the calendar, and you can't omit it from your numbers. 2022 occurred, and that is what is driving down our historical absolute as well as relative. Now we're back into 2000, or the end of 2020.
Yeah, and we've talked a lot about this. I mean, sometimes we use the term high beta, but our portfolio is definitely a portfolio that's structured to capture the upside, perform very well, and participate in strong markets, and we've certainly done that and participated in that.
I'm just kind of surprised, just going back to, I guess it's page 8, the 3-year period, which would include 22 and 21. By and large, we were underweight fixed income, which is, the equity markets were down more than fixed income. I get it, but fixed income is where the bulk of the problems reside. And it's very hard to get lift off remaining in fixed income. So we were underweight that portion of the market. I'm just surprised that over a 3-year period, we wouldn't have looked better relative to our peers.
What is our ranking over 3 year? We're like in the 2/3.
Yeah.
Fixed income, we're underweight. Where we kind of look different from many of our peers, so public pension plans, particularly the ones on the smaller side. So again, we're comparing ourselves to $100 million plans to $1 billion plans. So there's a lot on the smaller end of the side. They tend to have much more weight in public equities, particularly U.S. equity, and particularly large cap. I mean, there's not, as you kind of move further down in terms of size, and the portfolios kind of tend to look a little bit more retail, actually.
Okay.
And so there tends to be a lot more, particularly U.S. equity, large cap equity, and in, not some international, but the split is much different than us. We're, kind of 60-40 U.S. international from our equity split. A lot of the folks tend to be kind of 75-80 on that lower end. I think, and we've kind of talked about this internally, we're trying to get more data to break this down. And the other thing is there's not a ton of real estate. There's not a lot of, real assets within these portfolios, particularly this last year, as this hurt quite a bit. So we've kind of asked our provider actually if we can get a little bit more breakdown in terms of kind of the size of plans and where they fall. But that's kind of tend to be in our experience what we've found.
Anything else, man?
Hey, you, look at that pretty baby.
If I look at the, if I look at the 3-year number, actually, I guess I'm looking at this is end of October, so let me try and look at our real estate portfolio, which, I mean, we're underweight fixed income because we have the allocation to real estate. So instead of being more like a 60-40, we're a 60-20-20. But real estate is up over the 3-year period. Fixed income is down. Real estate at the benchmark level is up a +6, and fixed income's down a -5. So again, I'd be curious, just the allocation effect. I mean, the allocation to real estate over the 3-year period should have really helped us out.
Well, again, it depends where it's coming from. So we're 15% real estate.
Right.
So I would imagine, I think the median in this peer group is about 7.5.
Okay.
So we're double on the real estate side. And to your point, the assumption is that it's within fixed income,
Right.
but it's not necessarily.
So
within fixed
what's the peer group? Do you have a sense of where their fixed income allocation is?
25%. I mean, typically what we find within public pension plans, I mean, and again, I wish I had the data, but
So not so much 60-40. but
it's not so much
70-30.
60-40, but it's not only that, but then there's also hedge funds within the portfolio. And again, hedge funds is kind of this ambiguous thing, but a lot of institutional plans have allocated hedge funds over
Even the
fixed
smaller
income.
ones?
Oh, yeah.
Okay.
I mean, fund of funds,
Okay.
but even fund of funds, again, over the last 3 years, while bonds have been negative, again, they haven't been rock stars, but they've been 3, 4, 5%, these
Yeah.
diversified hedge funds net of fees, which that's a big delta from the fixed income.
Okay.
And no, I mean, these are great questions, but, but that's where, I think you can kind of see that. So page 26. And I think this gets me, you're talking about Brian and Milt, you were making these points. So this is our portfolio and our peer ranks but it's just on a 1-year basis. Right? And so
Okay.
you grew at the last 3 years. And so first off, Paul, Milt was directing this to you, but again, my comment on our portfolio, kind of higher beta portfolio, you look at 21 and 22, we're in the top 10% of other public pension plans in, relatively strong up
2021,
years.
not 22.
Sorry, yes, 2021. 22, so the one certainly that pulls us back. And yes, there's kind of equities fall off quite a bit, but also fixed income, that was kind of big year. Bonds fell off quite a bit. And so kind of what we've seen, again, I would venture to guess a lot of the peers from this standpoint having some of that allocation in diversified hedge funds, for instance, where would have protected relative to a public bond allocation.
So if the median peer is more like 25% fixed income and 7.5% real estate, with the bulk being more domestic equity, how are we more high beta than they are? I mean,
Because
that's a lot of equity exposure. Right? I mean, then you're almost 70% equity, unless you've got whatever the hedge fund allocation.
that's right. So for instance, there's diversified hedge funds in there, which break it up. And we have private equity as well, which
Yeah.
the other ones have.
I think this is really worth discussing. However, why don't we do this at the next meeting? Because why don't you bring in the comparison with our peers, more specifically than asset allocation?
So, and that's what I said. I don't know if I'll have that. I mean, we have,
Okay.
That data does exist.
well, we have to go back to, we're a little bit in terms of the granularity we would like to see on the peer groups is we have to go back to the provider of the data to get that.
Yeah.
So we'll certainly, kind of do that in our best.
Yeah.
And I mean, there's, we can look at other studies that aren't necessarily public plan specific, but broader institutional plans and how they're allocated, but that'll be a little bit different as well.
let's see what we can do for the next meeting.
Yeah.
Okay.
Other questions, I guess, just on the quarterly and our performance numbers? Again, I have our October performance, but, you know, we've talked quite about that. October was the same dynamic, right? You know,
Well, historically, as I recall, August and September are usually the two worst months of the year for US equities, and international tends, at least Europe tends to follow that. September even more so than August. This year, August wasn't, it was relatively flat. It wasn't really horrible. September was horrible, and October was horrible.
September, October were both pretty horrible.
November's been marvelous.
Yeah, to put perspective on it, so the ag, our benchmark is up almost 4% in November. In equities, both international and US are up 8 to 9%. So numbers look quite a bit different. November numbers, we still, I guess, have a couple of days left relative to the end of October.
Yeah, in fact, I think the Russell 1000 for the month of November is up, as of last night, just for the month, was up 8.7%.
Yeah.
So it's been a good month.
Yeah, I mean, yeah, that's, it's, you know,
We have September data here. We have to focus on it.
right.
But I've always found it tricky, even when I was in consulting, I found it tricky to talk about September, which is usually right in the middle of the downturn for the calendar year. October is often a recovery year. This year it hasn't been,
No, well,
but November certainly has been. So I just find it tricky to talk about anything ending in September.
yeah,
Whereas June and December, I feel very comfortable.
The challenge with the November recovery is, at least if you look at the bond market, it seems to be forecasting a pretty aggressive cutting environment,
Yeah.
in sooner rather than later.
Yeah.
Which is, you know, concerning in and of itself, because if the Fed, who's kind of clearly committed to higher for longer, has to start cutting that aggressively, that quickly,
There's something underlying.
there's gonna be a problem in the equity market. Up there. And so and if that's not the case, if the Fed is able to engineer higher for longer, either through using other policy tools, to, you know, hold off some of those issues in the equity market, then the bond market is probably undervalued. Not undervalued, rates are too low. And as you get a rate move up, there's probably more
It's just
more issues. The fixed income may be back to looking like it does here at the end of
Wasn't it
September.
just a month and a half ago, maybe even less than a month and a half ago, the 10-year note?
Five.
And as of this morning, it's like 4.45 or something like that. That is extraordinary.
If I can make, so I will we'll see what we can find on pure data for next month, but 2 points on that I do want to leave it. First and foremost, we can find some data on pure asset allocation, but again, as you guys know, every plan is different. Every plan's discount rate is different, their needs.
If you don't have recent data, our asset allocation hasn't changed. Why don't we just go back to the end of calendar year 2022 for asset allocation comparisons?
Well, yeah, my question really gets at, is it an allocation effect? In which case, as long as you're comfortable with their allocation, fine. Is it a manager effect? There's something with one of our managers that's different relative to, you know, or is it a fee issue?
Yeah,
Because we are comparing net to net. And so that's what I'm just curious. And again, like I said, if it's an allocation effect, you know, then as long as we're comfortable with this allocation, I don't have an issue with it. If it's our managers are underperforming, we ought to look at that. And if it's a fee issue, we ought to look at that too.
yeah, no, I mean, you're asking the right questions, and I think, again, I mean, you know, I'm on 24, but again, it's also important to remember the difference, especially over, you know, a year or three between the 50th and even and where we are is very close in terms of performance. But you're asking exactly the right questions. And if you kind of look to, so even starting on page 27, as you get to our manager standpoint, and this is where I was, you know, going through, and I'm looking down, for instance, we can just look at the 1 year, because that's where you asked about the 3 year, Brian, we'll look at that. But you look at, you know, again, we're in the 2/3, the 64th percentile relative to the peer group. From a performance standpoint, the bulk of our US large cap, for instance, is in passive, which continues to do very well. Rumline and passive managers in the top third, relative to all large cap core managers. And you can see our two active managers on the side certainly have trailed Genesis, we've talked about quite a bit, who, look at their 3-year rank versus their year-to-date rank. I mean, that's how they bounce around based on how well growth is doing.
Yep.
And is that going to perform? You look within US, kind of small mid cap, and I'll just even look at the top line here. Our small cap portfolio over the last 3 years is up 9.8. Russell 2 was up 7%. So I think, again, managers continuing to, I think, perform quite well.
Yeah.
International certainly, has been the part that's pulling it back, and it kind of gets to a little bit of the, our small cap allocation, which we'll kind of talk to next. Our managers there have struggled, both William Blair and Monterey. We've talked quite a bit that their kind of quality bias has pulled them back. We've just added Silchester. Of course, Sanderson had a strong rebound, as we remember, this year. So actually their 3 years would look relatively well in this portfolio. And actually WCM has, continued to rank pretty well on the growth manager side. And so we outside of our international small cap, again, that's more so of a structure standpoint. We don't have concern with any of our managers. Again, within EM, you point out, we made that decision, what was that, 2-3 years ago now, we had LSV and Acadian, we just switched to Acadian. You can see, over the last 2 years, Acadian's actually positive by quite a bit when the benchmark is down. Western, certainly their longer duration. I mean, this is really kind of, being pulled over the most recent time period has hurt them.
You also have the, again, Western is one I think is worth looking at. I mean, we had the AT1s with Credit Suisse.
Yeah.
Got the duration call, and they were in here, I think, last spring and talked about, so it's fine. I have, Milt, I think you lived through it, but the Archdiocese, they were a real problem in the financial crisis. I mean, where we couldn't get marks and things like that.
Are you talking about Sanderson?
No, we're talking about Western.
Western.
Wasn't Western because they had all the partnerships inside of partnerships, and it became an accounting issue. So I mean, I have a little bit of I trust your judgment, and we've talked about it a couple of times, but that's probably just one to relook. Again, duration will probably help them out as we look at November. So this may not be the quarter to cast the final straw on, but that's a challenge.
Well, no, I mean, they certainly not only on the duration side, and then they certainly move out on the risk spectrum too. That's what they're known for, over a long period of time, added yield. But given what happened, particularly in the 2022 event, and even kind of during COVID, especially in that beginning part, when there's a flight to quality that really went against them as well.
Yeah.
And so, again, going back to, and this is great for asset allocation discussion we'll have in January, but kind of the role for fixed income in our portfolio, right? At the end of the day, we're trying to hit our 7.25% return per year. And we really need fixed income to be that ballast in a downturn when we could access liquidity from it. And so is IRNM, which is on the opposite end of the spectrum, is Western. I mean, they certainly play that role, but is it enough? Do we need more from that standpoint? But you're hitting on kind of the right areas, right? I mean, I think if you asked about the 3 years and is it a manager perspective, I just, all these different gray bars as you look at it, just our real assets versus the Odyssey over the last 3 years, we're ahead by almost 2%. We're a little bit behind on fixed income, really led by Western, we talked about, by about 70 bips. International, we're down too by about 70 bips versus the benchmark. And the overall portfolio over the last 3 years, really led by small cap, which has hurt us. US small cap on the other side, we're up about 2% over the last 3 years per year. Again, managers been doing well. On the large cap side, we're down, again, what is that, about 80 basis points relative over the last 3 years. And for the most part, really led by Jennison there because of really what happened, really strong outperformance this year, but what happened last year really hurt them.
Because of the nature of large cap growth.
Right.
And specifically their portfolio.
Yeah.
Tesla has a large position, and Tesla last year was just dreadful,
Right.
and this year it's double.
Yeah.
So it depends.
So it just, I mean, to kind of wrap this up, so to get to your point, you're asking our questions, it is a manager thing. Looking at this, okay, international small cap, obviously we're talking about, we have, we certainly want to talk about. Western, I think we understand what they're going for. Is it the right fit for our portfolio? We can continue to address that. But otherwise, I think managers continuing to do well. I can confidently say I don't think it's a fee issue. We do our fee analysis every year, and we continue to rank kind of, certainly on the lower quartile, if not median, relative to peers from an active fee standpoint. So I think it's just, again, even just going back to this, while we're, 65th percentile for 3 years isn't certainly ideal what you want. That difference between that and kind of just on the other side of half isn't that different in terms of return.
And in large cap, which you point out, I mean, yes, it's Jensen, but it's an active versus passive issue.
Right.
Which I know your position is passive for large cap, but I worry about the concentration issue within the 7 stocks. I don't know that, when you did the breakup of the portfolio and recomposition, I don't know that the active versus passive allocation we have has mitigated that concentration risk. So
Yeah, it's the bottom line.
I'm just trying to think through it.
Well, you asked the right questions. So we've jumped around a lot on performance. Like I said, November markets, we've seen returns move up quite a bit. Is there any other questions, or do we want to transition a little bit just to talk about international small cap and our allocation and structure of that? So that's actually a separate deck, the international developed equity discussion. So we want to pull it out. So we laid out a few bullets here on the first page, but first and foremost, again, we're talking about our international developed markets. We're not talking about emerging markets for this discussion. We have that allocation. Very happy with it. Katie continues to do well. We still want to invest in emerging markets, but our developed markets. So again, you think of, for the most part, that's Europe, Japan, other areas. We do have 4 managers there. Silchester, WCM, Silchester on the value side, WCM more on the growth side. And then we've historically had 2 small cap managers, Mondrian and William Blair. Certainly the bulk of the allocation has been with the larger cap managers, Silchester, WCM. Again, just as a reminder, Silchester entered the portfolio a couple months ago, replaced Sanderson. And in that transition, and we'll kind of talk about this, both Silchester and Sanderson, there are certainly some similarities between the two, but also some pretty big differences. And one of the big differences is with Silchester, they definitely tend to go, as we say, all cap. So there's a large cap side, mid cap, small cap, and even below. And Silchester, much more than Sanderson, kind of tends to go lower cap in their portfolio. So the question is, are we now currently too much of an allocation to our national small cap side, and how should we think about structuring that?
On a see-through consolidated basis.
Yes, see-through consolidated basis. So pages 4 and 5, and again, because I want to make the point that we continue to like small cap within international. Just like, again, within the U.S., you wouldn't be naked U.S. small cap. We don't think you want to do that international small cap either. There's a lot of upside potential with that, a lot certainly of diversification there. So pages 4 and 5, what these two are, and I'm just going to hit some highlights of both these pages. At ACG, we have what we call playbooks. We have them for all the asset classes we're invested in. And the point of a playbook is to say, how do you think you would approach an asset class? Forget which manager you're in, but structurally, what's the best way to invest in various asset classes? So page 4 just, certainly is, developed international, kind of the overall space, both large and, mid, and even small, et cetera. And what are kind of the important aspects there? Well, first and foremost, it's a very large marketplace. We're talking about many, many countries, many, many stock indices. So our benchmark, the EFA index, has 800 stocks in it. If you were to look at the ACWX US, which occurs in emerging markets, it's over 2,300 stocks. You talk about it's much less concentrated than the US market, Brian, to kind of your point you were bringing up earlier. And that's kind of just this graph here at the bottom left-hand side of the page that, this just compares the S&P 500, the EFA, and then the ACWX US, but kind of what is the largest sector? You can see, no surprising, the S&P 500, it's information technology, it's over a quarter of the index. The largest sector in the other two international stocks much lower. What's the biggest stock in the index? You can see Apple, 7%. Brian, your point about the S&P 500 concentration, much lower than that in international. So international, much more broad. We also continue very much to think active implementation with international makes sense. And that's kind of that graph on the top right-hand side. And we reviewed this actually just a couple months ago. But again, what this is looking back historically, net of all fees. What's the average? The top 25th percentile manager has done, the median, and the bottom quartile over time. And so even the median manager, net of fees, tends to outperform by 80 basis points per year relative to the benchmark. That shows there's opportunity there. But then kind of what I want to point to, and really kind of the discussion we're talking about here is, this is the middle of the page. We call this the foundation of consistency. But what this is saying is if you were to, and there's large cap indexes out there, there's mid cap indexes out there, large cap growth, mid cap value, et cetera. But if you were just to pick one of those indexes, and so we go back to 1994, and for every 3-year period over that, whatever that is, 22 years, 30 years, what percent of the time has that specific index, mid cap value or large cap growth, et cetera, been the best place over a 3-year period? And so that's how what's kind of plotted in these boxes right here, is what percent has been the best. And so interestingly enough, if you look at value and growth, just even has it over international, has it been better to be in value and growth, percentage wise over this last 30 years, it's 55-45. So relatively close, a little bit more in value, but relatively close. But then kind of, large and mid in this example, and you're kind of comparing different indices, quite a bit different, 61-39. So again, what this is telling us is you get down in market cap, there tends to be a return advantage the smaller you get, particularly large versus mid. And actually on page 5, it's the same concept, what we want to do, but it's, all right, let's focus specifically on small, mid cap. So again, similar story, I'll just point you to that middle of that page, this foundation of consistency we're saying, again, going back over the same, almost 30-year period as 28-year period, very similarly, value and growth, 52-48. So really, there's not a clear winner between value and growth over this time period, where you can see 65% of the time, one of the small cap indices would be the top, 35% one of the mid cap. So again, highlighting as you go down in market cap, there is this ability to outperform. And then again, just kind of the other thing that we think is very interesting is just how much certainly diversification it can add to the portfolio, an opportunity set. This bottom graph on the left-hand side of the page is we're looking here at the MSCI. This is the All Country World Investable Market Index. So this is kind of all the stocks globally that you can invest in. And there is, however many that is, almost 10,000 different securities out there. And this is kind of the breakdown between large cap, mid cap, small cap. But then that's the number of stocks. But then to the right-hand side is what is their weight in the index. So actually that large cap, which is about a third of the overall group, makes up 91% of the benchmark. So in other words, 2/3 of the stocks only represent a 9% weight. We think that's an opportunity to add to our portfolio, again, to be able to help outperform going forward. Again, and I don't need to go through all these different things, but again, the advantages, you look to the over on the bottom right-hand side of the page, why, again, at the top, you can see, again, it makes sense to be active in international small cap. We've continued to see strong outperformance from active managers. Similar thesis within international small cap relative to US, they tend to be underfollowed. What does underfollowed mean? It means it's hard to have an information advantage when you're trying to get insight on Apple. Do you want to buy Apple? Are you going to have an information advantage? There's so many people covering Apple, it's hard to get an information advantage. With small cap securities, you can actually, if you spend some time on it, you're probably going to do some more research than others. You have an opportunity to add value. Less concentration, but also this is a key difference I want to point out is at the very right-hand side of the page here, higher quality within international small cap relative to the US. With small cap companies, again, they're smaller, there is a risk, potentially they're starting up, they might run out of business, they're not as well capitalized. The percent of the Russell 2000, the US small cap, that actually companies have no earnings or negative earnings is 40%. Much smaller on the international side. So in other words, actually, it's a much higher quality international small cap relative to US. So again, I just want to make the point we're talking about here. What I'm going to say is I think we can have a chance to shrink down some of our dedicated small cap exposure, but we continue to very much still like international small cap in our portfolio.
One time in Germany, I recall from my days at Monsanto, you could not take a company that had no profit public. I don't know if they still have that regulation, but that was probably not at the time in a number of smaller countries. But that was in Germany. You had no profitability, you couldn't go public.
No, I'm certainly tied to regulations, for sure. So, well, I have to page 7. And so what we're looking at here is the breakdown of our managers as well as, so our developed benchmark, again, the EFA index and how it breaks down from a market cap perspective. And you can kind of look at it on the bottom, kind of right to left is the biggest to the smallest. So mega cap, the largest companies to the international marketplace, large cap, mid cap, small, and then micro. You can add there, and you can see, so the EFA index, it's about almost half mega cap, 40% large cap, and it has almost 10%, a little bit less in mid cap securities. WCM, our first manager, much larger cap. We're getting we're getting strong exposure to the mega caps there. Hop over to that fourth bar, that's Sanderson. This is what we used to have in our portfolio. So certainly kind of mega cap, mostly large and mega cap, but about 25% of the portfolio was in mid and even some in small there in yellow. Well, again, we switched Sanderson, with what's to the left of that, Silchester. So you can see quite a bit. Silchester it's more than 50% in large cap, but it's getting kind of close. So again, in Silchester, who's had great returns, we continue to like what they're doing. It's kind of a byproduct of their research focused on the cheapest quintile, but they certainly go down lower in that market cap. And then, of course, Mondrian and William Blair on the right-hand side, as you would expect. They're pretty much, William Blair's got a little bit of large cap, very small, but pretty much all mid and small cap exposure that they're adding to the portfolio. So I can come back to page 8 if you'd like, but page 9, so Milt, kind of what you were asking about is what does this do to us at the aggregate portfolio level? So again, the EFA index is on the left-hand side. This is our benchmark from that we compare ourselves to. But again, we continue to think there is value in going smaller in market cap space, including mid, including small, including micro. So we would like to have more of that exposure than the EFA index. So that's the EFA on the left. This middle one, former target portfolio. This is what we had with Sanderson in the portfolio. So you can see we did have that overweight relative to the benchmark, and it's particularly mid, but also small and micro cap names in our portfolio. Adding Silchester is where we are at that current target portfolio, that second one. So you can see moving up a decent amount relative there. And so this is where, given Silchester, frankly, in some ways, what they're doing somewhat makes our exposure with Mondrian a little bit redundant, particularly just because it's a smaller cap value manager. So what we're saying here on the right-hand side, okay, we could potentially all the way to the right. What happens if we remove both small cap managers? And so got rid of Mondrian and William Blair and just said WCM and Silchester. It does get us closer to the benchmark, but I think, frankly, what we think we're missing out on is some of that yellow and even some of that purple there exposure, that small and micro that we still want to have in the portfolio. But is there an opportunity to reduce from our current portfolio to that fourth one, where it's just one small cap manager.
Phineas, is our target allocation for international small cap 5%?
There is a target,
Our actual is about 4.5. That's our target.
we do have a target to international small cap. It's, well, it's 15% of our international developed portfolio, is our target to small cap.
Fine. What is our, I understand that. What is our
So
specific?
international developed target is 19. So 15% of that is gonna be 3.
It's 3%. That's, and I don't think that's quite right. I think it's more than 3%.
Unless you're including EM. You get EM, now you're,
Well, at the end of October,
Little
it was,
25.
it was 4.5%. So what's the number?
So our IPS, I said, our target is to develop the 19%, and then under it is within that, it's, you know, was that 85% large, 15% small.
The overall number that you mentioned, that excludes emerging markets.
Yes.
Well, at the end of October, we had
That would
14
extend that well
international
number.
large, and we had 13.8 and 4.5 on the international small. So that's not even 19. That's 18 cents. So I'm just trying to get the right number. So we know where we're coming from. I'm looking at the October 31st data. International small cap 4.49, international large cap 13.84. That's actual, that's not policy. That's 17.1.
yeah, you're over allocated to small. Yeah.
So is our target 19% for the two?
For the two, yes.
We're just underweight one or both. As of the end of October. Something just doesn't seem right, but okay, go ahead.
So what you're seeing kind of on these pages, what we use, these aren't our current values. These are when we say targets, that's where it comes from. So these are based off the IPS. So if we were to put, again, if we were to put Silchester, WCM, Minder, and Ware based on our IPS targets in our portfolio, this is what it will currently be.
All right.
So going back to, again, kind of our current thought in our portfolio is where we were previously with Sanderson, having about a little less than, I mean, you know, call it, 30-ish, a little more than 30%. And again, we're including mid-cap in this. So mid-cap, small, micro, we think is an appropriate way to attack international developed markets, given kind of everything we talked about in the playbook pages. Adding Silchester, that moves up quite a bit, does create a little more tracking there at the total portfolio level. It also creates, so we need a little more overall volatility in the portfolio that, we makes sense to, frankly, shrink down, instead of having two small cap managers, bring it down to one.
Thoughts? Ryan?
I just big picture, Milt, I don't see, I appreciate the distinction. I don't think it's that significant of a difference. And I'm glad it's being pointed out, but ultimately I think it's ACG's call. So I feel like you're giving us information around your views of portfolio construction. I'm fine with that. We'll have an opportunity to judge those decisions over time.
Right.
I would be for one small cap manager. It looks, I mean, particularly with Silchester, it looks like, again, relative to the policy statement, we're over allocated to small cap. which,
That's what it appeared.
right, which I'm scratching my head at a little bit because it looks like, except maybe the most recent, if I'm looking at the quarter maybe, but for almost all the periods, it looks like small cap has underperformed the EQI or the EFA, except when you get to the 10-year numbers where it's really outperformed. So clearly the first 5 years of the decade were really good for small caps, and the large caps have outperformed since. And so that would explain part of the drag on my thinking of the last 3 years, is having that allocation to small cap, both domestically and internationally, has been out of favor in the moment. Now, that doesn't mean you shouldn't have it. That just means you want the allocation. You just want it to be in line with our IPS. And so I think giving your allocation to Silchester, it probably makes sense just to have one small cap manager. And then if you can combine, if there's a way to kind of measure what's in the Silchester portfolio and the one international small cap manager, and make sure that's below kind of our 15% threshold, or targeted to our 15% threshold. That may be harder because, I mean, what kind of a lag do you get the Silchester information?
We get it quarterly. So a couple, I guess, points of clarification, and it could be my fault. So our current IPS, again, we have the 19% international.
Yeah.
I apologize. It's 30% to small cap, 70% large.
Okay.
But then but that's, again, that's bucketing like matching the
15
managers.
growth,
It's
15
not,
value.
yes.
Okay, that's where the 15 came from. Okay. Then we're fine.
But it's matching the manager. So in other words, it would be Silchester would be matched to large cap, Mondrian to small cap, William Blair to small cap. It's not at a look-through basis. And so what our thought is if we reduce that 30 to 15, basically, so at the manager level, but knowing that Silchester is one of the large, on the look-through basis, again, we're really kind of closer to where we want to be and where we were. And Brian, your point about, I skipped this page, but it's, whatever it was page 7, I think, or excuse me, page 6, but exactly that, on kind of the 5 and the 10-year performance difference of the EFA broadly versus the small cap. It's kind of, over 10 years, it's as you would expect. I mean, it's similar to US. It's outperformed, the small cap's outperformed over the last 10 years, but it comes with more volume. And that's just kind of the nature kind of the small cap. And so that kind of also certainly impacts our sizing thought there.
All right, another, Brian, I'm sorry, do you have a follow-up point?
No.
I just want to make certain something else is clear to the board. The average small and mid cap exposure within Silchester over the past X number of years, how many years?
So that's
10 years is 34%.
that's just to mid. The small cap is 6.
Pops out of 10.
So that's 40% the small and mid.
Yeah.
That is the average. Now, I presume you don't feel, based on your conversations with Silchester, that they are likely to deviate substantially from that, because we could, in any particular year, wind up with an under allocation to small cap or an over allocation to small cap, depending on how volatile that 34% or 40% is.
Correct. I mean, it fluctuates. You can see this over the last decade, so it certainly fluctuates with, I mean, they're relatively tight bands, but they fluctuate, and they have the ability to fluctuate further. Now, again, this kind of goes to, this is why I don't think we can, and it makes it hard to create a policy based on the look through at the manager level, because they have the discretion to move up and down, and we really can't control that. So what we can control is how we allocate to the managers, knowing that Silchester, again, I think is relatively consistent, but again, they can fluctuate within this space more so than what we had in our portfolio. I think it's, let's keep this in mind, and kind of as we then kind of structure our portfolio, that we probably are a little bit, it's not top heavy, the opposite, bottom heavy, in terms from a market cap perspective.
So you're recommending that we have only one small cap manager per se.
Correct.
A separate recommendation as to who that small cap manager would be. Would it be William Blair? Would it be a manager yet to be named? Or identified, I should say.
So I think it would be a manager yet to be named. It wouldn't make sense to get rid of William Blair and keep Mondrian because in particular, we already have Silchester on the value side going smaller and you really are becoming redundant there. William Blair could potentially be a decent pairing there because we have Silchester going smaller on the value side. WCM is more mega growth, so William Blair could fit that. That I think is worth discussing. So it's a separate meeting, we're gonna discuss this. But going back to some of these playbook pages, overall, I think we want a core allocation international small cap.
Why?
Because going back throughout time, you can see there's really no benefit to overweight in one or the other.
Well, we're gonna have substantial overweight the small cap value if you have a core small cap manager. Because you're gonna have Silchester there, which is value. And then half of that core manager, this hypothetical core manager, only half of that is value. So you have a relatively small allocation arithmetically to small cap growth.
Right, and so we want to factor that in as if we think about a replacement manager for both William Blair and Mondrian. And so there are managers, as you can imagine, that kind of, they fit that spectrum, if you will, in terms of, kind of growth and value and not necessarily 100% core. So we would want somebody who certainly at least leans that way, but I think it's worth at least having the separate discussion of, let's not just assume William Blair is the perfect fit. We've got a few kind of managers that we like that could potentially also fit as well to have that discussion.
If we're just Silchester and William Blair, what see-through allocation would that be to small cap value and small cap growth? How would that compare here?
So, and I don't have the specifics on me, but I think what you can see, I would have to come back on that, Bill. I can maybe do some of the math right here, but I'd have to come back to you on exactly how that breakdown is. I think it would be relatively close. So if you look at it again, because you have to factor in too, Silchester also would be, 3 times almost the allocation of William Blair. And then about, let's call it 40% of their portfolio is non-large. Now, they have more in mid-cap than William Blair does. William Blair has more in small, and then certainly in micro. So there's a little bit more math than I have here, but yes, Silchester on the value side and William Blair be on the growth side.
Well,
I think at this point, what I was hoping from the group was is there an agreement that just from a structure standpoint, it makes sense to go from 2 to 1, and then we can spend a different discussion, flush out the specifics of, again, it could be William Blair. I think for all the questions you bring up, Bill, it makes sense. But I also think it's worth, let's just also look at others, how that potentially pair as well.
I keep thinking there's about 5,000 companies in the international small cap universe. About 5,000. And it seems to me it's a real task to find the top 100 that are really going to make your portfolio successful. And I'm not sure I would entrust that with one manager. And here we have 2 managers, right?
Right.
Matter of fact, at the moment, we have 3 managers. And so we're trying to, your suggestion is bring it down to 2.
Yeah, but
Go ahead.
no, even if you were gonna bring in a core manager, you would still want the growth, an allocation to a small growth manager to the Silchester.
That's not what he said.
I know, but that's what I think
I think we need growth.
I think you'd need growth, yes, to be able to pay. So if you're gonna use a core manager, I still think you need a growth manager.
I agree. I'm just offhand. I think we need a growth manager rather than a core manager. That's just offhand.
And then the sizing.
If in fact we think,
Sizing sets.
we call Silchester back, you and I and Tammy have been familiar with Silchester for, my familiarity goes back 2008, actually. And we call it value. But in some cases, it's pretty core. I mean, it's really not
Yeah.
what I would call strict value because of their valuation process and their stock selection process. And so I don't know exactly. I need to see a little bit, I personally, I'm not speaking for the entire board, need to see a few more numbers here on a see-through basis to really understand the nature of the beast we're dealing with here. I'm not opposed necessarily to having one nominal small cap value manager, but I'm not sure what the complexion of that manager ought to be because I'm not quite sure of the complexion of Silchester today.
Well, I think the migration from Sanderson to Silchester requires a relook at the small cap allocation, whether it's one manager or two. I don't know yet, but Silchester brings the market capitalization down. So I think you could either reduce your exposure to small cap because you're getting some of it from Silchester already, but I think you need to look at the growth value after you've kind of deconstructed the change that Silchester's introduced.
Yeah, I mean, I think we definitely plan to address some manager specifics after this, but I guess kind of first and foremost is get the demonstrator there in agreement. And I get your point, Brian, that I guess it kind of depends on manager specifics. But at the moment, our international portfolio is becoming pretty high, non-large, given the addition to Silchester. And so exactly kind of, how we shake that out. But, and then also you think about too, William Blair and Madrid are worth about 2.5% of our portfolio, overall portfolio. At some point, I did each. So, we don't want to be hiring managers at 1% of our portfolio because then that's just not moving anything, driving the needle at all.
I agree.
And so kind of this really kind of leads to our thought of, given Silchester we know is, swimming downstream, fishing in this pond, it structurally probably makes sense to just have one, how that.
The other thing that
One is fine, but I think we need to look at changing no matter what. I mean, in each of the periods, neither of these managers have broken the bottom quartile. Okay,
are you talking about William Blair?
William Blair and Madrid.
Yeah.
I mean,
yeah.
there's a host of managers that have done better than them.
That is correct.
And so,
We would not have come to that conclusion at the end of 2021.
True.
Because William Blair had just, I think, relatively stellar performance.
Okay.
Over I'm thinking 2021 backward, rather than 2022.
Small, okay.
Yeah, so I think.
That's fair.
I basically agree with your sentiments, but I think we need to, for ACG to push some more numbers to try to give us a better idea of what see-through.
Yeah.
On a see-through basis. The other thing that bothers me, and I don't know if it should bother me, but how much of Silchester's performance year in and year out is really generated by their small and mid cap exposure? That I don't know. And they could have 20-40%, but if it's concentrated. Well, I keep thinking
It explains some of the
Apple,
reasons.
Apple, Microsoft, Meta, NVIDIA kind of thing, that you have 500 stocks in the S&P 500 and 7 of them, actually 9, represent 70% of the gain. And I'm just wondering if we might have the same phenomena within Silchester.
It probably explains some of their, I think over the last 5 years or so, they haven't been nearly as extraordinary.
As they get credit.
And it's, I would imagine it's the allocation to.
It's certainly, it's 40% of their portfolio, right? That's going to drive a decent amount of their performance. There's no doubt about it. And so,
Not necessarily.
well, it's going to have a significant impact.
Yeah.
And now again, keep in mind, Silchester, their benchmark is the EFA index. That's what they're trying to beat, or the EFA value with some folks, but it's really the EFA. And so they're still trying to outperform that. But again, that's, I mean, just to compare the IFA versus them, it's a pretty big divergence in allocation.
We're now talking generalities, and I'm guilty of that as well. I would like to see some more numbers. Based on what we discussed here, on a see-through basis. See what we've got.
And so, and again, like I said, I think that's,
I'm not opposed to going to one international small cap manager. The question is, which manager of what complexion to complement rather than repeat what Silchester's already doing. And I can't see a reason to wind up here with and we may wind up, but with an overweight, a substantial overweight, the small cap value in our international small cap portfolio. So we have, given Silchester's size, it may be tough to avoid and overweight the small cap value in this international small cap portfolio. So I just need to see some more.
yeah, no, we'll bring that down. And I think manager specific obviously matters when it gets to it, but yeah, I mean, you're kind of hitting what I'm saying. I mean, as of right now, we certainly have an overweight to small cap value, even small cap overall. And so just, as long as the group agrees with that, we can bring certainly some ideas back. But again, I don't think it's adding two more managers, even if we, replacing two, adding two. I think it's looking at how can we get a complement, either it's with, keeping William Blair, or it's a different manager, the complements that Silchester has on the non-large side, which is overall to, again, kind of fit that structure.
Well, as I said before, if Silchester is truly valued as opposed to core, it doesn't make sense to have two replacement managers, one being valued.
Right,
Arithmetic makes some sense.
right.
So that manager, that new manager, should be one manager, which is a growth manager. That I understand, but I'd still like to see some more analysis to say what is the appropriate next step. And we're not in a hurry. I mean, we can do this at the next meeting.
Oh, yeah, no, I mean, again, this was not a make a decision here discussion. It was why we're looking at this and make sure we're all kind of a consensus and at least structurally the best way to move forward.
And whoever we hire, if we hire somebody new, it's gonna take 3 months to make that.
Yeah.
So I think we have time to make a more reasoned decision than the data that we have here.
And I would include in that even just a little tinkering on the sizing, and I can appreciate that, de minimis sizing for managers, it doesn't really help us. But even if you just reduce the weighting to Mondrian, that alone might help get you a little bit more in line. And you can also very easily just add the IFA index as a way to just keep in line, reduce that tracking error relative to the benchmark. So think about that too. It's not just the numbers, but what are the portfolio construction techniques? And it may actually be simpler than what we originally contemplated. Instead of replacing managers, Mills, I'm thinking that, just adjusting sizing
Interesting thought.
might work. It's a simpler way to get there.
When managers are clean, it makes everything,
Yes, yeah, for sure.
situations, our decisions more difficult when they aren't clean, when they're just not definitively 100% growth. And if nobody in the organization ever uses the word value, then you know what you've got. But when it's a mixture, you're not.
Yeah, there are too many.
And I honestly don't know what Silchester is today. I suspect it's core with the value bias. But I didn't think of doing that. And if it's really core with the value bias, then we need to look at this in a different way. As opposed to being purely that.
No, I agree with that. I mean, again, I think we're kind of good, but
We've got time to make the right decision. I just want to make the right decision so we're not revisiting this at every meeting, asking the same questions. We could get all resolved up front. Again, I'm just one board member suggesting this.
no, yeah, I think we're all on the same page here. And I think so. Yeah, we'll bring back that, but I think kind of nothing else. It's, we need to look at this further. As we stand now, we are overweight, small cap, certainly in our portfolio, probably more on the value side.
Can you think of anything else you want to talk about at the December meeting?
November numbers, which hopefully
Yeah,
should be good.
Unless something dramatically goes wrong within the next 36 hours, should be pretty pretty nice.
Yeah.
November should be a nice month. So we can afford to spend
Yes.
the appropriate amount of time to nail this thing at the next meeting, one way or another.
Yeah.
Okay. When? What else?
That is all I have for today.
Alrighty. Anything else from the board on the performance aspect or decision making aspect on this small cap allocation? And if not, we have on the agenda another update by the drop task force.
Not much to report this month. We've asked Foster and Foster to run an analysis of what a drop program would look like for St. Louis County. So we're waiting on those results, which will guide some further discussion and some decisions.
Okay, fine. If the ordinance has been submitted for the increase in the compensation or increase in, fee. It's been submitted. Not yet approved because the budget process is not yet approved, or is that one thing been approved?
No, it's on final passage for tonight. And the Foster and Foster contract's on final passage for this afternoon's meeting.
Oh, good.
Yeah. And so then,
I can't imagine anybody would object to it because it would come directly out of the pension plan. The county per se doesn't put any money in just to compensate, to pay that.
and then just amending the contract and getting it executed. So,
Good. Still on our way.
Can I just
Anything
make,
else on that?
I don't know, just one cleanup comment. Vinny,
Yes.
you said we're overweighted to small cap, and I think at 30% of the overall, even if you include Silchester, even if you include Silchester small cap, we're not above the 30% of the international allocation.
So including the, I'm
So-
including
so if I
the
take-
cap exposure there.
So mid is
So,
included.
I'm sorry, I didn't mean technically with the IPS for.
Yeah, okay, that's what I was trying to.
Still within IPS parameters.
Yes.
But if you look at Mondrian and William Blair together, now with Silchester, we have more than we had previously with just Mondrian and William Blair. So
You're
that's
still,
what
you're
talking
still
about.
under.
Yes, we're still, well within one
Yes, the
guideline.
market cap is pulled down by the.
Okay, any other business for this meeting, or we're going to go in executive session? Is there any other business for this particular meeting or suggestions for the next meeting?
do you, we have the agenda item, just if there's no other business, then visitor comments would be before.
Well, I just want to get the other business first.
Oh, I'm sorry.
All right. Anything further? All right, we're open for visitor comments and then we'll go to executive session.
Just two things. Can we know the name of the private equity investment firm that we're using? And can we know the topic of the closed session, not any particular, just the topic?
The name of the firm is Portfolio Advisors. What's in the document? What do you have? Don't you have Portfolio Advisors in the document, or do you have PA?
I'm assuming it's the portfolio advisors. Unless just on this, it says private equity and then it's in the back. Oh, yeah, portfolio advisors, we have the name of the fund, but it's portfolio advisors, the name of the firm.
Is that in the document?
No,
have the
it
acronym.
probably is in this document, I'm sure it is, but we just have the name of the fund.
You have the acronym there.
Yeah,
Okay, fine. But the subject of this upcoming closed session, though, you
So.
May not.
Legal matters.
Thank you.
Can I check this real quick?
sir,
Joyce, did you have anything you wanted to comment? Trying to unmute you.
You're being asked to unmute yourself. To unmute, press star 6.
My apologies. Can you guys hear me? Can you hear me now? Good. Thanks, Matt. Hi, everybody. For those of you that don't know me, I'm Christina Capizzi. I'm with the County Counselor's Office. I'm sorry.
On those on the call, we're having technical difficulties.
Some of
I
the-
recognize him scrambling, yeah.
All right, I muted them.
Just a second. I don't have the finance investment background, but I used to be a consultant and I've done some punting. And I saw all evidence of the punting strategies.
And then the other.
Are you all waiting on me?
No,
Just
hang
hang on,
on.
please.
Okay.
You are essential but not sufficient.
Are we ready to, are we, okay. Because we haven't voted yet.
There's no one else out there, just Christine, correct?
Well,
Joyce is not there.
not yet, but he's shutting us down to
Well,
go into closed session.
well,
but only
we
bringing
need to
in-
vote to go into closed session first before you can go into closed session.
We said, we wait. Are you ready?
Yes, sir.
Okay, all those in favor, it's been moved and second call.
I'm sorry.
Oh, that's right, it's roll call.
It's a roll call vote to go into closed session. So Matt would, yeah, Matt would take.
Brian moved it, or I did for Brian.
Thank you.
And I'm second.
All right, so roll call. Brian Hanson,
Present.
Paul Hample,
I'm sorry, somebody,
Yes?
yes, okay.
In favor, sorry.
Paul Hample,
Aye.
Lieutenant Colonel Joe.
Yes.
Jody Pettis,
Yes.
Anthony Moskowitz,
Yes.
Milton Wilkins.
Yes. Sometimes parliamentary procedure screws up good meeting.
It's the mouse that's over there that I should have had, and I apologize, everyone.
All right, we are in executive session.
Christina,
Could you start, Maggie, could you first state what the purpose of this session is?
well, and Christina will explain it further, but there, and it was actually in the newspaper yesterday.
Yeah.
There was a settlement, regarding the Tim Fitch
We have unanimity.
At least one item of business.
Thanks, Brian.
Thank you all.
Thank you.
So you're going to go into tomorrow.